Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next 20 minutes here on Options Guide TV. Now, I am traveling, and on this Wednesday's show, we're actually going to go into great detail on just long call spreads and trading them around to earnings. It is the season for earnings, and we have two trades that we're going to look at today. One of them is going to be the first trade that we put on last week on Disney. That is, well, I guess it turned out to be a diagonal spread. I was going to say a time spread, but we decided to change up the strikes a little bit. And Disney is doing well right now. The trade in general is doing well. And I just like time spreads or diagonal spreads, something where you're trying to control the implied volatility spike that you get around an earnings event. And also, we're going to look at a trade in Netflix today. And now, as far as Netflix is concerned, they're announcing on a Thursday, which always makes it interesting to trade a high price stock when they announce on a Thursday and the option contracts have 1 day to live, which would be Friday. So they're announcing on the close this Thursday. The date is officially October 17th. And then we're going to be basically the options have 1 day to live, October 18th. And the trade that we're going to look at in Netflix, and then we'll go back and review the Disney trade, mainly because I have this trade all set up and rocking and rolling, is going to be a skip strike butterfly. So, I'm neutral to bullish on the marketplace. Well, I'd say maybe I lean the other way. I'd say more neutral on the marketplace than any out of those two. Heading into the election, I think there's going to be a lot of volatility, a lot of chop, and so far that has played out in the markets. They can't really decide which way they want to go. And the Fed is, all over the place once again with, do we need more rate cuts? Did we go too much? So there's just so much going on. Then you have the geopolitical concerns. I don't mind doing an earnings trade. I don't mind doing these type of trades when there is chop in the marketplace. Looking to get more long positions after the election. Let's get that big event over with, so it is a known event at that point in time. And then I do think that the market can, is open to decide if it wants the Dow to go to that 6,000 level, which, if you haven't bought your hat yet, you might want to put in your order because you don't want to be the only one at the party without the Dow hat. All right, so here we go. Right now, Netflix is here. We're trading at 716 is down 588. Now, I have taped the show for Wednesday because I am out of the office per se. And this trade I would look to put on Thursday. And I want to emphasize that. I wouldn't necessarily set it up the way I have it right now. I would wait till Thursday and I would look to put on the trade. But I'm going to give you all of the ingredients to be able to set up your own trade going into Netflix earnings. And I'm going to be neutral and a little bit bullish. I kind of think the marketplace can at least make the expected move on Thursday, and we're hoping that it's going to be to the upside. But if it isn't, we're going to do a skip strike butterfly, which I've mentioned many times on this show, that I think of a skip strike butterfly more as a credit spread, where in this case, we're going to be on the bull side of things, and we're going to sell the call credit spread to help pay for a normal butterfly. So you're putting your hedge into that trade. So we're selling a credit spread to pay for a butterfly. Right now, it's trading at a 68-cent net credit to the account, but there is a fairly substantial requirement. Because if you see here inside the what if calculator, if the market goes to the middle section here, right here at the 800 level, you would be at your max gain. But this is a 20-point wide butterfly. We skipped the strike that would make it a normal butterfly. So in this instance, that strike would be the 820 strike. And we're going to adjust this a little bit. Okay, it's 780, 800. This would be 840. I hope that gives me a decent credit. 2 cents. All right, I want to change that up a little bit. Let's go 845. All right, 25-cent net credit. We'll go there. All right, so in this instance, we're going to have a $2,500 requirement on this trade, and that should be our max loss. If the market takes off on us here, it should be $2,500. Let's send this to the trade ticket, and let's take a peek at this. All right, yeah, that's where we're at. So if we do this one, we do got a $4,000 requirement. Okay, so on the what if calculator, we need to change up this strike. And let's look to do that. So our strike here in this instance, move this. I'm going to change it to a 45. I don't want that big of a requirement. I don't mind it, but it's a little bit too much. There you go. So the requirement is going to be around $2,500 less the net credit brought into the account. So we're going to send this to the trade ticket. And you're looking to, we're hoping that the stock will make a move, about a 1 standard deviation move, up towards the 800 strike. That's a nice big round number. Stocks have a tendency to kind of hang on those numbers. Around in earnings, it's always a volatile event, obviously. So in this instance, that's what we're targeting. We'd like the market to start down here where it's at and drift towards this middle strike. We will have a $2,500 requirement if we do this trade. So it would be like doing a 25-point wide credit spread. We're going to bring in a net credit to the account of 20 cents, which means that if the market goes this direction, we make 20 cents on the trade. So our ideal situation is that a Netflix would announce earnings, the market would go up and drift in this range, making about the expected move, not the 1 standard deviation move, up to about 780 and just kind of hang here. And then in the afternoon, start making its way up towards our short strike. That would be the ideal situation if we did that. And the maximum we can make on this trade would be $2,000, which is the difference between 780 and 800, the difference between those strikes. Now, if it opens up and it blows us away on the marketplace, we can go all the way up to about the 820 range, and that's about where we're going to break even. But from 820 on up, we have risk all the way up to the 845 level. That's where our protection kicks in and limits our loss from that position going forward. So with the market right now at 716, and if we go back to the trading page, you'll see here that we're centering this right around the 1 standard deviation move, right? The the Tradier Pro software is showing us that a 1 standard deviation move on the October 18th expiration is right around the 790 strike. So we're kind of straddling where a 1 standard deviation move would be at. We'll notice that the delta is very close to 16, and this the options grid highlights that 1 standard deviation move. 1 second. So that's how I would set it up. Based off of where that stock is at on Thursday, I would look to be right around a 1 standard deviation move. I want to be selling something very close to that. I want it to be feasible so that it can make that strike. But if the market just goes up about the expected move, which means the expected move is we're buying the 715 strike call, and at the same time buying the 715 strike put. That's the most at the money long straddle. And we'll call this not quite 60. We'll call it 58 points, but I'll make it 60 just to make life simple. But the expected move, which is basically the over under as of right now, and that number is going to obviously change by Thursday, but we're looking at around if we're saying that this is 60 points, it's a little less than that. We're going to be around the 775 level. So right about here is where the expected move is at. So we're going beyond that, beyond a 1 standard deviation move before our risk kicks in. And based off of the math here on 820, the delta is implying that there's about an 8% chance that the underlying stock will finish at least 1 cent in the money above 820. That's where where our risk kicks in. And there is about a 5% chance that the underlying can go beyond our maximum risk, meaning that we would lose that $2,500. So anything is possible when it comes to earnings, especially in the mega cap tech stocks. So I think the probabilities in general are a little higher than what the delta is implying, is the way that I would say this on this trade. So keep that in mind, that with earnings, anything can happen. But we set up this trade. We got a high price stock. We got a high probability of making something. We may be able to close it out at a real nice profit in that they're announcing on a Thursday. If the stock drifts higher and close to somewhere between the 780 and the 800 level on that expiration date, you got 1 day to trade it. But if it does blow away the numbers, it is feasible. And I've seen it before with a mega cap tech stock where the stock could open 2 standard deviation moves. And that's basically what we're looking at here, that there is a very low probability of it reaching our maximum loss on the trade, but really realize that there is still a probability that could happen. And that's going to be my earnings trade for this week in Netflix. I like the things that make Netflix attractive is the fact that it's a $716 stock, and the fact that they are announcing earnings on Thursday after the close, and these option contracts that we're looking at right now only will have 1 day to live. So if the expected move happens and it lands somewhere in this on the open, well, then you just hope the stock drifts a little bit higher and gets within this range right here. And if you go back to the what if calculator, that means that you're trading somewhere between here and here. Now, if you put the trade on today, this is your profit and loss graph as of today, me implying that if the market did go to this range that we're talking about, we would not be profitable on that trade until we got closer to the expiration date, until time passed on that trade. And you can show it this way. If I grab the calendar, we're here on Monday. Let's go all the way to Thursday, which is before the earnings. Now it's starting to make that turn and be profitable. You go to Friday. This would be Friday at 11 o'clock a.m. Eastern time. And you see from 11 o'clock on, if you are correct on your forecasts, you get rewarded very quickly. And hence the reason why I don't mind doing this strategy on Netflix when they announce on a Thursday. So to say that a different way, if they were announcing today and these option contracts had 4 days to live, they had all day Thursday, all day Tuesday, Wednesday, Thursday, and Friday, I might not do the strategy. I would pick a totally different strategy. But we're going to live in this world that if Netflix does make the normal move, and it is positive, which is the expected move after earnings, and it drifts towards this level, I don't mind this trade. I don't mind this trade at all. I'm willing to take on this risk, but realize that it is a real number, $2,500 for every 1x2x1 butterfly that you put on. But if the market just goes down, oh well, we tried and we got out and we made 20 cents on the trade. Our risk is going to be about 20 cents or our upside is 20 cents on the downside, the net credit that we receive from the trade. All right. Now let's run back and look at Disney and just do a quick review of our Disney trade. I like where this one is going at this point in time. We are drifting towards our short strike heading into the earnings, which is perfect for Disney. So this is ideal if you're doing a time spread. You'd like it to move in your direction, but you just don't want it to move too quickly. So in Disney, let me clear this out and I'll set up our diagonal trade that we put on. We went out to the October 25th expiration and we sold the 97 strike call. So we are bullish on Disney. We're bullish on Disney. And we have a known event, which is that earnings, and that's going to happen on the 14th. So we're going to sell the 97 and then we're going to buy the 95. All right. So we put this trade on, well, today is I think we did it on Friday is when we put this trade on. And we want the stock to drift towards 97, which means that our longer term option contract will be in the money. We don't have any additional requirement because here we have the right on our longer term option contract to buy the stock at 97. And we have the obligation to sell, or at 95, and have the obligation to sell at 97. When we put the trade on Friday, it was $3.30. Now let's call it $3.60. We wouldn't close the trade out. So we're up 30 cents on the trade. The market is up 72 cents since we talked about it. So like I said, ideal. We want this expiration date to come. That is 11 days away. So each day that goes away, our near-term option contract is losing money. This one, the 97 strike. And we want that to wither away. We want time premium to go away in this. Ideally, we get close to this expiration date on the 25th, 11 days away, and the stock is trading just south of 97. Then, at that point in time, we can either close out our long call position, which should be up quite a bit because we're going to get a bump in implied volatility. And this option contract is more in the money, obviously, than the 97 strike. And if we want to, we could also roll again. And we could roll out either to the November expiration, or we could do another roll to the November 8th expiration. We have 2 more expirations that we can choose from. So right now, stay the course in Disney. I like the direction that it's going. It's behaving very well. And this will just kind of be this will be a fun one to watch, and we got some time to trade it. If we have to adjust it, we'll adjust it. I don't mind adjusting it. Oh, what would you do then? Okay, and a question popped up. Ethan is asking, what would you do in Netflix today? Oh, that's a tough one. I'm mainly, and Ethan, I don't know if you came in right at the beginning, but this Wednesday's show is all going to be education about trading around earnings. I have an event that I have to do on Wednesday, and I cannot be here to tape the show live for Options Guy TV. So I don't think I would do anything in Netflix today. that big known event, if you wanted to buy the stock or you wanted to get more bullish on the stock, there is a way to trade it, like selling some puts, trying to bring in some premium. But I would probably avoid trading Netflix today because that known event is on Thursday, and that's actually the only expiration. If we go back to Netflix and FLX, you're trading volatility by doing this October 18th expiration. Implied volatility is going to increase on the option contracts going into the earnings date. So there's no daily options. Yeah, I would avoid trading Netflix today. I guess I'm just going to leave it there. I'm trying to come up with something off the cuff here, but I would just avoid it, and I would put the trade on Thursday ahead of the earnings, and I would use the same type of philosophy that we talked about today. We want to go beyond the expected move, which that's around 58, 59 points. So you're talking about the 775 level. I'm going to go beyond that, and then I'm going to set up my strikes. I'm going to be buying this one. I want to go about 20 points wide on my butterfly. That's one thing about this, an expensive stock. I do want to go a little bit wider on the butterfly, which creates a little bit more risk if the worst case scenario did happen. All right, any other questions that we may have? Because we're coming to the end of Options Guide TV. I will be back on Friday, the 18th. That's basically the kickoff of the FANG stocks. I know nobody talks about FANGs anymore. Netflix kind of gets snubbed as far as the mega cap tech stocks. They used to be in the center of it, but now everybody talks about the Mag 7 and NVIDIA and everything that's going on with that. But Netflix always kicks off, is always the first stock to announce out of the stock. So the following week, we're going to have Apple, Alphabet, Amazon. All those stocks will be announcing next week. So to me, that's the heart of the earnings season. So I'll definitely be back, quote unquote, in the office next week, and we'll be looking at some of those trades. So thanks for stopping in. If you, please do share. You can follow me on x.com. My handle is @BrianOverby. We do stream these live through the x.com. But if you do want to participate and you want to ask a question, please go to hub.tradier.com and log in. And once you set up a profile, you can ask questions via that platform or via the Tradier YouTube platform. We'll see you next Friday, but do stop in on Wednesday for the special educational event that I spent time taping this week. I think you'll really like it, talking all about setting up long spreads around earnings events. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.